Ever stop and think about what really powers India's economy? I mean, beyond the big headline companies, we're talking about the small businesses, the local shops, the startups, the real heartbeat of communities everywhere. They're often unseen but vital. And what if I told you there's a huge financial move happening right now, specifically designed to give these businesses a major boost? Today, we're doing a deep dive into something pretty significant. UGRO Capital, a big name in Mumbai finance, just announced they're buying Profectus Capital, and the price tag, a massive euro 1,400 crore, all cash. Now, this isn't just about big numbers, it's a strategic bet on India's future. Our mission today is to figure out what this actually means. For entrepreneurs, maybe for investors, or, just if you're curious about how economies really tick.
Exactly. This is more than just another deal announcement. It really highlights how dynamic India's financial sector is becoming. And consolidations like this, they're absolutely crucial. They help empower those foundational layers of a fast-growing economy. It's about getting credit flowing to the businesses that drive growth from the ground up. A very clear signal, I think.
Okay, so let's unpack this deal. June 17, 2025, UGRO Capital says it's acquiring Profectus Capital for 1,400 crore. And like I said, all cash. What does an all-cash deal like this signal to you in this kind of market?
Well, an all-cash deal, especially one this size, it really speaks volumes, doesn't it? It generally points to UGRO having a strong cash position, loads of confidence in Profectus's value, and the synergies they expect right away. It makes the transaction cleaner, faster, sure, but it also means UGRO is putting serious capital on the line, shows real commitment to this strategy.
Right. And to get the scale, let's look at the players. Profectus Capital, they weren't small fry. A significant non-banking financial company, an NBFC, operating across 7 states in India, 28 branches, more than 800 people on the team. And as of March 2025, their assets under management, the AUM, was about 3,468 crore. Pretty substantial.
Definitely substantial. NBFCs like Profectus play such a vital role. They often step in where traditional banks might not, especially for smaller businesses, the MSMEs. They fill a critical gap.
Now compare that 3,468 crore AUM with UGRO Capital. They were already a heavyweight, right? Their AUM was 12,003 crore. So Profectus becomes a wholly owned subsidiary, and boom, the combined entity has a massive over 15,471 crore in assets. It's like UGR is adopting Profectus, promising to nurture it.
15,500 crore, almost. That immediate scale-up is fascinating. What it tells us is that in this MSME lending space in India, which is growing fast but still quite fragmented, just growing organically isn't enough for the ambitious players. M&A, like this deal, becomes the express lane to getting the scale you need to really compete, to dominate even. They're essentially buying market share, infrastructure, customer lists, all in one go. It's aggressive.
So why this specific company? Why Profectus? What's the strategic thinking behind spending a 1,400 crore on them?
Well, okay, first off, the immediate jump in size. A 29% boost to UGRO's AUM, just like that. Overnight. It's like adding a turbocharger to an already decent engine, a significant leap forward.
Absolutely. But it's not just about size. Profectus brings something quite special. Deep expertise in school financing. This is a niche UGRO wasn't really playing in, and it's a market segment with, well, a lot of potential, often underserved.
School financing, interesting. How much potential are we talking? UGRO actually estimates this could unlock around 2,000 crore in new growth. It shows how these specialized lending areas are becoming really valuable. Think about it. This deal could mean a school somewhere gets funding for a new computer lab, better facilities, real, tangible impact.
Beyond the niche, there are hard numbers too. UGRO expects to save 115 crore in operational costs, synergies, I suppose, and add 150 crore in profit every year. That's a direct hit to the bottom line. Plus, they expect their return on assets, the ROA, to improve by maybe 0.6 or 0.7%, so more efficient use of their assets.
And critically, it leads to a stronger, safer loan portfolio. This is key. Profectus's loan book, it's fully secured, meaning there's collateral backing those loans, reducing risk, and their bad loan numbers are impressive. Gross non-performing assets, or NPAs, just 1.6%. Net NPAs even lower at 1.1%.
How does that compare to UGRO's existing book?
It's significantly better. UGRO's existing gross NPA was 2.3%, net was 1.6%. So bringing in Profectus's cleaner book pulls down UGRO's overall risk profile quite nicely, makes the whole operation more robust.
Gotcha. And there's another angle: relationships. Profectus brings established connections with private banks and small finance banks. That kind of network takes years to build. Now UGRO gets, more friends in high places instantly.
Right. And if you tie all these pieces together, the instant scale, the cost savings, the ROA boost, the new expertise in schools, the better portfolio quality, the new bank relationships, it all fits perfectly with what UGRO's founder and MD, Shachindranath, has been saying. His vision is clearly about achieving scale quickly, boosting efficiency, and driving towards being India's top MSME lender. This deal ticks all those boxes.
Okay, makes sense strategically, but it still begs the question, where does routine 100 crore actually come from? How are they funding this? Well, UGRO's been busy raising capital. They recently pulled in a 1,315 crore. That came from two sources, a 400 crore rights issue and a larger 915 crore preferential issue of something called compulsory convertible debentures, or CCDs.
Okay, let's break those down quickly. A rights issue that's basically offering new shares first to your existing shareholders, often at a discount. It's a way to reward loyalty and raise cash. Then the preferential issue of CCDs. They offered these special debentures. Think of them like IOUs directly to a select group, probably big investors. And compulsory convertible means these IOUs must turn into UGRO shares later on. So investors give cash now and get ownership down the line. It aligns interests, like promising a friend a slice of the pizza once it's baked.
So out of the 1,400 crore needed for Profectus, 950 crore comes from that fresh capital they just raised. And the other 450 crore, that's coming from UGRO's own piggy bank, their internal accruals, basically, profits they've saved up.
Right. A mix of new money and existing cash reserves. But it's important to remember, this isn't quite a done deal yet. It still needs the nod from the Reserve Bank of India, the RBI. That's crucial. And UGRO's own shareholders have to approve it too. Assuming all that goes through, the plan is to start merging operations from April 1st, 2025. Gives them time for a smooth transition.
All right, let's quickly pull back the curtain on the main players here. UGRO Capital, founded way back in '93, but really transformed in 2018 under Shachindranath. They're known for being tech-savvy, using data for lending decisions, right? And they focus on MSMEs across India, Tier I cities down to Tier Phi towns. Before this deal, their AUM was just over 12,000 crore. And you mentioned they're big on co-lending. What's that about?
Yes, co-lending is central to UGR. It means they partner up with banks and other NBFCs. UGRO uses its tech to find borrowers and assess risk, but the partner institution puts up some, or even most, of the actual loan amount. Actually, 42% of UGRO's AUM before this deal was off balance sheet because of these partnerships. It lets them grow much faster, reach more borrowers, without needing all the capital upfront themselves. It shares the risk and reward.
A very smart model. Okay. And the company being bought, Profectus Capital. Smaller, sure, but clearly well-run given those low NPA numbers. Backed by a global private equity firm, Actis. And their CEO, KV Srinivasan, seems quite positive about the merger, talking about the synergies and complementarity. Sounds like he sees a good fit.
Definitely. Low bad loans suggest strong underwriting and collection processes. Being backed by Actis also lends credibility.
And Actis, the seller. They're a major global PE player. They invest, grow companies, and then, well, they exit. They've been pretty active in India lately, selling off other investments too. This is kind of their business model.
Exactly. Buy, build, sell.
And naturally, a deal this big needs advisors to make sure it all goes smoothly. You've got Incred Capital on the finance side, S&G and Partners handling the legal stuff, and PwC doing the accounting checks. The usual suspects for a major transaction.
Absolutely essential to navigate the complexities of a deal like this, making sure all the I's are dotted and N's crossed.
So we've talked Crores, AUM, NPAs, strategy. But let's bring it back. What does this UGRO Profectus deal actually mean for, you listening? For the everyday person. Well, first and foremost, it should mean a boost for small businesses in India. These MSMEs, they employ something like 111 million people. That's huge. They contribute almost 30% to India's GDP. So when UGRO and Profectus combine forces, potentially making more loans available, that translates pretty directly into more jobs, more local products, more economic activity. Your local shop that tailor down the street, they might find it easier to get a loan to expand, buy equipment, hire someone. It fuels that grassroots growth.
And don't forget the schools. Profectus' specialty in school financing, now potentially scaled up by UGRO. That's significant. It could be more schools getting funds for essential upgrades, classrooms, tech, labs, whatever they need. That benefits students, obviously, parents, teachers. It's an investment in education and community infrastructure, real-world impact.
And all this creates ripples, right? An economic ripple effect. Growing businesses buy more supplies, hire more people, pay more taxes. That tax money funds public services, roads, healthcare. Plus, a stronger MSME sector makes the whole Indian economy more resilient, better able to handle shocks.
For those watching the markets, there's the investor angle too. UGRO stock did see a little bump on the announcement day, closing up about 0.82% at Euro 2,303.15 on June 17th. Analysts seem generally positive, often rating it a strong buy with higher target prices. But, it's important to be realistic. Finance stocks often aren't quick wins. They're more like marathon runners. Steady growth is the aim. And it's worth noting UGRO's stock has had its ups and downs. It was actually down quite a bit, about 38% over the 12 months leading up to mid-June 2025. So this deal is a strategic bet for future growth, but markets can be volatile.
Good context. And just how big is this MSME world they're playing in?
It's vast. There are roughly 63 million MSMEs in India. 63 million. The total loan amount to MSMEs grew nearly 18% just last fiscal year, reaching about 64 lakh crore. That's enormous. UGRO's ambition. To capture just 1% of that market? Sounds small, but 1% of 64 lakh crore is, well, it's a huge number. Shows the scale of opportunity they see.
Okay, so the potential upside seems clear, but no big move like this is risk-free. We should look at the potential challenges too. What are the main hurdles UGRO needs to clear to make this acquisition a real success?
That's right. Always need a balanced view. The rewards are clear. Instant scale up, diversification into schools and supply chain finance, that nice profit boost of 150 crore annually. Big positives. But the risks, integration is always tricky. Merging two different company cultures, IT systems, ways of doing things that can be bunky, cause friction, cost more than expected. Then there are the regulatory hurdles we mentioned. RBI approval, shareholder approval. They aren't just rubber stamps, they need to be secured. And market volatility is always a factor. Investor sentiment can shift, especially if the integration doesn't go smoothly or if broader economic conditions change. UGRO's past stock performance shows it's not immune to market swings. How will they manage these risks, the integration, the approvals, the market perception? That will really determine if this bold move pays off in the long run.
So wrapping up this deep dive, the core message seems clear. UGRO Capital buying Profectus for 1,100 crore is a major strategic move aimed right at the heart of India's economy, its small and medium businesses. It's a deal positioned to potentially fuel job growth, improve schools, and ultimately contribute to a more robust and dynamic economy for everyone in India. A calculated bet on the future.
Absolutely. And it leaves us with a final thought to chew on, doesn't it? When you see consolidations like this happening in the financial sector, especially in fast-growing economies like India's, how might this reshape the landscape for small businesses, not just locally, but globally? What kind of new innovations in lending and credit access, maybe driven by this combined tech and specialized knowledge, could emerge? Could this trigger a new wave of inclusive growth far beyond India's borders? Something to think about.